Hey everyone, and welcome back to Speak Accounting. Today we're diving into a topic that's crucial for understanding business finances: unearned revenue. Now, imagine walking into a gym and paying for a year-long membership up front. You've got access, but the gym hasn't earned that money yet. They need to deliver those workouts first. That's the essence of unearned revenue: receiving money for goods or services that haven't been delivered. So, what exactly is unearned revenue? It's a liability for a business, meaning it's an obligation to provide those goods or services that have been paid for in advance. Think of it as a promise. The business promises to deliver something in the future in exchange for that upfront payment. Let's look at some common examples. Advance payments for products or services. Imagine a software subscription you purchase for a year before even using it. Gift cards or prepaid memberships. When you buy a gift card or a prepaid gym membership, that's unearned revenue for the company. Deposits for future work. A contractor doesn't earn a deposit for a renovation project until the work is completed. Now, let's delve into the accounting side of things. Account type. Unearned revenue is a liability account, signifying an obligation the business owes. Debit or credit. It's a credit account. Remember, credits increase liability accounts. Current liability. It's typically classified as a current liability because the obligation is expected to be fulfilled within a year, like that yearly gym membership. Income statement or balance sheet. Unearned revenue is recorded on the balance sheet under liabilities. It doesn't appear on the income statement until the revenue is earned, meaning when the goods or services are delivered. To illustrate, let's look at some real-world scenarios with journal entries. Scenario 1, prepaid subscription. Initial entry. A customer pays $120 for a 12-month subscription to a streaming service. Debit, cash $20. Credit, unearned revenue, $120. Adjustment. At the end of each month, the streaming service recognizes a portion of the unearned revenue as earned. Let's say 1 month's worth of service is delivered. Debit, unearned revenue, $10. Credit, service revenue, $10. Scenario 2, gift card purchase. Initial entry, a customer purchases a $50 gift card for a bakery. Debit, cash asset. Credit, unearned revenue, $50. Adjustment. When the gift card is redeemed, the bakery recognizes the revenue. Debit, unearned revenue, $50. Credit, sales revenue, $50. Now, let's move beyond the basics and explore some deeper considerations. Potential risks. Businesses need to be mindful of refund policies, especially for service-based businesses. Money-back guarantees can create liabilities related to unearned revenue. Accurate revenue recognition can also be challenging when goods or services are delivered over a longer period. Impact on financial ratios. Unearned revenue can influence the current ratio, making a company appear less liquid. It can also impact profitability ratios, sometimes making a company seem more profitable than it truly is, especially in the early stages. Accounting standards. The treatment of unearned revenue is governed by GAAP and IFRS, providing guidance on proper revenue recognition. Examples, beyond the ones we mentioned: software licenses, insurance premiums, travel and hospitality, professional services, and e-commerce subscriptions are all practical applications and best practices. Businesses should develop methods for estimating and tracking revenue recognition. Strong internal controls are crucial to prevent fraud and ensure accurate accounting. In conclusion, understanding unearned revenue is vital for businesses that receive advance payments. Accurate accounting ensures financial statements accurately reflect the company's financial position and performance. By being aware of the potential risks, impact on financial ratios, and practical applications, businesses can manage unearned revenue effectively, leading to greater That's all for today, but don't forget to hit that like button if you found this helpful. And be sure to subscribe to Speak Accounting for more accounting insights and tips. For even more accounting resources and information, head over to